Everyone's watching for a recession, but the real threat to the global economy right now might come from the market themselves. Here's why. Over the last 2 years, markets have become a massive, self-reinforcing machine. Stocks, bonds, even currencies are moving less on fundamentals and more on algorithms, leverage, and liquidity flows. When everything's fine, that makes things look remarkably stable. But when something breaks, the same mechanisms can amplify small shocks into global crises. Take the bond market. In 2024, U.S. government debt ballooned past $36 trillion. Yields spiked, not because of a default risk, but because investors started demanding higher returns just to hold the debt. If those yields keep rising, governments worldwide could be forced to spend hundreds of billions more just servicing interest, crowding out everything from healthcare to defense. Then there's equities. Trillions are now parked in passive funds and AI-driven trading systems. These don't think, they react. If a sell-off starts, they automatically dump assets, pushing prices down even further. That's what turns a correction into a crash. And don't forget liquidity. Central banks have stepped back after years of money printing, but private markets are still loaded with cheap leverage from that era. If credit tightens or yields spike again, you could see a chain reaction of forced selling, from pension funds to sovereign wealth funds. The irony is that markets designed to allocate capital efficiently could now be the biggest source of global instability. This isn't about predicting the next crash. It's about understanding that the system's safety nets, central banks, regulation, diversification, might not work the way they used to. When the plumbing of global finance becomes the threat itself, stability is just an illusion.